Hi everyone. In this video we'll talk about assets that should be classified as non-current. When assets are not expected to be converted to cash or consumed within 1 year from the balance sheet date, or operating cycle if longer, they are reported as long-term or non-current assets. Typical classifications of long-term assets are investments, property, plant, and equipment, intangible assets, and other long-term assets. Your book shows an example of Nike's comparative balance sheet. In illustration 3-6 of your textbook, you can see how Nike reports its long-term assets. In a few minutes, we'll start talking about investments, property, plant, and equipment, etc. But for now, I'd like to start a bonus point scatter question. The way this works is that I will embed a few bonus point words in several videos. When you run across them, write them down. By the time you finish watching the videos, you should have written down a question. I will award 5 bonus points to the first 25 students who reply to my question by the due date of the Chapter 3 homework. Here are your first bonus point words. What do? What, W-H-A-T, do, D-O. Investments are assets that are not used directly in the operations of the business. These assets include investments in equity and debt securities of other corporations. Investments include land held for speculation, long-term receivables, and cash set aside for special purposes such as for future plant expansion. These assets are classified as long-term because management does not intend to convert the assets into cash in the next year or operating cycle, if that's longer. Tangible, long-lived assets used in the operations of a business are classified as property, plant, and equipment. Property, plant, and equipment, along with intangible assets, are often a primary revenue-generating assets of the business. Property, plant, and equipment includes land to be used in the business, buildings, equipment, machinery, and furniture, as well as natural resources such as mineral mines, timber tracts, and oil wells. These various assets are reported as a single amount in the balance sheet, with details provided in the footnote. They are reported at original cost less accumulated depreciation or depletion for natural resources to the date of the balance sheet. Very often, companies will report only the net amount of property, plant, and equipment in the balance sheet and provide details in a disclosure note. Remember that land is often listed as a separate line item in this classification because land has an unlimited useful life and thus is not depreciated. Some assets used in the operations of a business have no physical substance. These are appropriately called intangible assets. Generally, these represent the ownership of an exclusive right to do something, such as a product, a process, or a name, that can be a valuable resource in generating future revenues. Patents, copyrights, franchises, and trademarks are examples. They are generally reported in the balance sheet at their purchase price, less accumulated amortization. Not all intangible assets are purchased. Some are developed internally. For example, instead of purchasing a patent granting the exclusive right to manufacture a certain drug, a pharmaceutical company may spend significant amounts in research and development to discover the drug and obtain a patent on its own. Another common type of intangible asset is goodwill. Goodwill is not associated with any specific identifiable right, but instead, goodwill arises when one company acquires another company. The amount reported for goodwill equals the acquisition price above the fair value of the identifiable net assets acquired. Balance sheets often include a catch-all classification of long-term assets called other assets. This classification includes long-term prepaid expenses, sometimes called deferred charges, and any long-term asset not included in one of the other classifications. For example, if a company's long-term investments are not material in amount, in other words, they're a small dollar value, they might be reported in the other asset classification rather than in a separate investments category. A key to understanding which category an asset is reported is management's intent. For example, management may intend to use land for long-term operating purposes, and thus it should be shown as property, plant, and equipment. If, on the other hand, management intends to hold the land for future resale, it should be recorded as an investment. If the company's type of business is to acquire land for resale, that's all they do. They might be like a real estate company, and management intends to sell land in the ordinary course of business, then the land should be recorded as inventory. Let's do an easy concept check problem. Which of the following is most likely to be reported as a long-term asset? A, accounts receivable, B, buildings, C, prepaid rent, or D, inventory. Please pause the video to consider your answer, then start the video again to check your work. The correct answer is B. Buildings generally benefit the company for several years. The other items listed are generally used or turned into cash within a 1-year period of time. However, it is important to note that some prepaid expenses could have been paid for more than 1 year. This situation doesn't happen often because cash is generally too scarce a resource to tie up in the payment of expenses over a long period of time. However, in some of your homework problems, you will find situations when expenses are prepaid for greater than 1 year in the future. It's easy to handle. Do some calculations and show 12 months of that prepayment as a current asset and show the rest in the long-term asset section of the balance sheet. Well, that's all for this video. In the next lecture video, we'll begin a discussion on the classification of liabilities on the balance sheet. Be sure to look for bonus words in the next video. See you next time.